Hello everyone, this is Przemysław Radomski talking to you on September 29th, and in today's premium video commentary, I'm going to talk about what happened on the precious metals market yesterday and what's happening so far in today's pre-market trading. The biggest news is what happened in the USD Index, and what happened is that it right now moved to new yearly highs. So this is a major breakout, and so far this breakout is not confirmed, but it seems that we finally might see confirmation of this move. That's yet another attempt in the consolidation that we saw after the breakout above the inverse head and shoulders pattern has been profound and it's relatively long, which means that finally the USD index can rally. Now, so far, the USD index is still very close to the previous resistance lines, provided by the previous highs. So it might still be vulnerable to a short-term downswing, but based on what I said 15 seconds ago, it seems that we might actually see a breakout's continuation this time. So the impact on the precious metals market could be really significant, and it might also be significant as far as the general stock market is concerned. And that's the second market that I would like to talk about today. Stocks declined quite profoundly yesterday. S&P futures are a bit up in today's pre-market trading, but they didn't erase even half of yesterday's declines. I previously wrote or said on video, I'm not sure which one was it, that the recent rally might have been just the early part of the right shoulder of a head and shoulders pattern. And actually that scenario is even more likely right now because we did see a decline. So if S&P declines even lower, below the neck level, marked with dashed line, so we'll see a breakdown right here, then it could lead to really big declines. All right, a move to last year's August highs would not be out of the question, even in the short run. Why? Because stocks are so oversold, and the effect on the precious metal, overbought. They have been so overbought. Rallying relentlessly, over doubling their valuation from the recent bottom, last year's bottom. The effect that this would likely have on the precious metals market would likely be profound, especially in the case of silver and mining stocks. And most likely, the biggest impact right now in the short run would be on silver. Before moving to silver, let's take a look at gold. Gold declined heavily from the short-term point of view, that is, yesterday, and it's back up today. It didn't erase the entire yesterday's decline, but the rally has been real noticeable, suggesting that we might see another even bigger short-term upswing. But even if we see it, it's not likely to be really significant, perhaps another $10 to $20 higher and then back down. That would be intuitively what happened in 2013, as you read in my previous analyses. It doesn't seem to be anything really bullish, today's pre-market rally. The downside target at the previous 2021 lows or close to them, and also mid 2020 lows. This target remains intact, and whether gold declines to it right away or in a back and forth manner, it doesn't really matter that much because it's very likely to happen anyway. Gold has still some falling left. It's before the decline is complete. But as far as mining stocks are concerned, I mean junior miners, we might see actually a relatively small move on a day-to-day basis, because so much of the declines is already behind us compared to where the mining stocks are likely to fall. Now, this chart that you're seeing right now is the GDXJ trading on London Stock Exchange, because I wanted to show you what's happening in the pre-market trading. At the GDXJ and GDX also trade on London Stock Exchange, so we have this early insight, seeing what's going on. But the implications are the same. There's while the decline is still likely to take place and it's likely to be visible, something that one could profit on, it's not as likely to be as big as what we already saw. And in fact, just like gold, junior miners are up in today's pre-market trading. And while gold and junior gold miners are up, silver is down. Silver is down by over half of a percentage point, and it's also below its recent support levels. So the technical situation here, in case of silver, is particularly bearish. And if you look at the downside target area, it's clear that the majority of the declines is likely still ahead, right? Compared to the decline that we saw recently, the decline that's likely to follow, even if it is to just the upper part of the target area, it's likely to be quite significant. Again, let's compare that to what's happened and what's going on in junior miners. It's not the same in this case. It's the opposite, actually. And that's in perfect tune with what's usually happening in the precious metals market. Miners are early to move and silver is light to move. This is clearer in case of rallies, but at times it's visible also in case of declines. And it seems that it's also the case in this decline. Why? Because of the where we have support levels in case of junior miners and in case of silver. Once silver ends the current consolidation and it declines, it has no strong support all the way down to much lower price levels. Consequently, at this time, it seems that it's a better idea to be shorting silver than to be shorting junior miners. And that's why I sent the intraday alert yesterday with the idea to switch from the short position in miners to a short position in silver. All right, so summing up, the outlook for the precious metals sector remains bearish. And in the short run, it seems that silver is very well positioned to decline a lot. And therefore, I think that short positions in silver are right now particularly justified from the risk-reward point of view. And on a final note, I received a message from one of our subscribers. Hello, Simon. It was about committing a deadly sin, in particular about calculating the potential profits that we might have on these trades, because, well, the decline, then perhaps come back or not, and then, well, profits on the continuation of the huge slide. And they are enormous. Why is it a deadly sin? Because it makes one think that they are already so wealthy because of this trade, and they could be so excited based on that they could increase the sizes of their trading positions beyond what's reasonable. All right, and it's a really dangerous thing to do, because yes, it's very likely that these moves will happen. Yes, I do think that profits that could be reaped based on these moves are huge, but it's far from certainty. All right, it might not happen. There are some black swan events that could prevent that. Okay, it's not likely that anything like that will happen, but let's not put ourselves in a situation when one's account could be wiped out by such a random or unlikely event. That's what makes one stay in the market and be ready to take advantage of the next trades. All right, you can't position yourself in a way that would make you vulnerable to irrecoverable losses on just one trade. All right, so let's keep the sizes of trades reasonable. The size of the trade that I'm describing is already huge, but it's huge based on well, multiplying the position size that is supposed to be very reasonable, perhaps conservative. So even multiplying that doesn't make it dangerous, shouldn't make it dangerous. If you feel that it does, or it makes you stressed, or you can't sleep at night, anytime if a position makes you so stressed, it means that it's too big for you to handle, and it should be made smaller, it should be decreased. There is no shame, there is nothing wrong with having just a small position and gaining a bit less than everything on a given trade. But it's a huge problem to be a victim of a sudden move in the opposite direction, getting one's account wiped out completely. All right, so I can't stress this enough. And this is particularly important for people who are just starting their adventure with trading and investing, because that's the top one reason for incurring losses. Too huge positions, too much leverage, and getting excited about a position, thinking about the enormous profits that are already kind of there, in one's imagination, could be dangerous, because it might make one make irresponsible decisions with regard to money management. All right, so that's the interesting and useful, hopefully useful fact or idea that I have for you today. No specific book recommendations or quotes. The above was the key detail for today, beyond the regular market analysis. All right, so thank you for watching, and have a great day. Bye-bye.